Hello and welcome to the Oil Market Analysis webinar. I'm Tom Ashby, Head of Global Communications for the International Energy Forum. I'll be your moderator today on this Zoom webinar, which is being broadcast live on Twitter, LinkedIn, and YouTube. So welcome to everyone watching. Today, we're privileged to have two distinguished oil market experts who will be giving us the benefit of their insights into the forecasts of the IEA, OPEC, and the EIA that were published in September. We have Rory Johnston, founder of Commodity Context, and Herman Wang, Associate Director of EMEA Upstream News at S&P Global Commodity Insights. I hope I got those titles right. So the latest oil market outlooks really come amid quite an intense period for energy market news, with the Middle East once again occupying the headlines. Despite Israel launching a ground offensive into Lebanon today, we've witnessed a weaker energy market. There were a couple of interesting headlines on Saudi Arabia, which I know you both have views on, so perhaps we might start with that. Firstly, there was the controversial story, I would say, in the Financial Times, citing anonymous sources that the kingdom was abandoning its $100 a barrel target to take back market share. A second was an announcement last night by the Saudi Finance Ministry, which cut its growth forecast and projected the deficit of 2.9% this year. So the ministry also reduced its spending forecast for next year, which I know, Rory, you had your eyes on that one. Crude oil futures have fallen from $90 a barrel at the beginning of this year to the low 70s now. So Rory, starting with you, perhaps you could just give us your view on what factors have contributed to the decline in oil prices, and do any agency outlooks provide insights into the reasons for this pullback?
Thank you so much for having me. So I'll just start with kind of what I see driving the currently low prices, because I think that we often talk about how price drives narrative, and we are in a low price environment right now. So I think the narrative has taken on a low price tone, but I think it's important to kind of disentangle what I see as like kind of the three major things that are always driving the oil price at any one time, and they are all telling very, very different stories. So I see oil prices as determined by a combination of current market conditions, which I essentially flatten into inventory positions, the outlook for fundamentals, or where inventories are thought to be going. This, I think, can be generally thought of as the consensus or the kind of general average tone of these three forecasts that we're going to be talking about. And then finally, I think there's a more mechanical kind of positioning element to it. And I think what we've seen over the past month in particular is that positioning has really been in the driver's seat. Current conditions, inventory levels are still low. By most indications, they are either below the 5-year average or whatever either kind of metric or yardstick for normality that we see, they are low. So current conditions are relatively tight. The market remains backwardated. These are all signs that this is not currently a market that should be diving $20 a barrel. That said, the kind of anticipated fundamentals at this stage, virtually everyone except for the OPEC Secretariat believes that 2025 is going to be some degree of sloppy, some degree of kind of oversupplied. And I think that, as we're going to talk about much more later, will depend largely on what OPEC and Saudi Arabia in particular decides to do with its production cuts. But then finally, I think it's that speculative element. I think and a lot of people have talked about this at length, but managed money positions or kind of speculative positions in these major crude contracts fell from relatively normal, even actually high levels as recently as July, to all-time oversold levels. So what we're seeing, I think, is a mechanical washout. I still expect that to kind of bounce back to some degree of normal, which is why I'm still short-term kind of, optimistic on prices, even if I think I agree with that consensus that 2025 doesn't look great. So I think it's like, trying to pull those things apart. But I think because of those anticipated fundamentals, no one is really coming in on the kind of physical or kind of, commercial participant side to catch any of those falling knives. Because, sure, if fundamentals looked like they were going to be strong, you'd jump in and say, this is ridiculous. But even if this is early, it's not necessarily ridiculous. And I think that's the challenge that we find this market in. So we know for sure spec is selling off, but no one's jumping in because as of yet, I think OPEC is leaving it sufficiently vague for next year, and I think leaning loose.
Interesting, yeah. So, I mean, you haven't actually addressed the kind of speculative stories on Saudi policy, which I think a lot of uh, people are looking at as well. What
All
did
right,
you make
I'll
of
be
it?
very, very quick, and then I'd love
Yeah,
to hear kind of Herman's
yeah,
thoughts on the broader price discovery as well. But
yeah,
I think so. The major story I think last week was obviously the story in the Financial Times that Saudi Arabia is considering, ditching its quote $100 price target in favor of kind of more market share. Now, I think the first thing that needs to be said here is that Saudi Arabia nor OPEC, itself has an official price target. But I think the broader kind of discussion of this kind of got lost on that technical point. And I think avoided the bigger picture of that story, which is that it's always going to be a debate or a kind of struggle, a tug of war between support for prices and an attempt, which OPEC's membership is, clamoring for, to normalize production. And I think it's always going to be a debate. So I think even if, sure, we've left $100 a while ago, I think what this tells me is it's telling skeptical analysts like myself that just because Saudi Arabia has, I think, aggressively defended oil prices over the past 2 years, I think arguably potentially even towards the kind of low triple digits, I think that they're saying that that is no longer sustainable. You can't hold these, 4+ million barrels a day of cut, 5.8 million barrels a day officially, 4.4-ish in reality. That's a lot of crude to hold off the market, and they need to normalize that. And I think it's responsible for the producer group to ease those production cuts in a gradual and kind of forward guided way, rather than run the larger bearish risk of holding off, and then running the risk that the entire kind of organization and deal collapses in one spectacular bearish calamity that brings us down to $30 a barrel. So I think it's really it's talking about how we manage this gradually and sustainably versus run this kind of larger tail risk of a broader, explosion. And I think the FT story really, for me, indicated that the kingdom in particular is leaning more towards we are serious, we recognize the necessity of these easings, and I think believe us when we say we're going to go ahead.
yeah. Good. Interesting point there. Herman, let's bring you in at this point. I mean, well, do you want to respond to that, view on the outlook for the kingdom, but also more broadly at the
Sure.
forecasts? Yeah.
Yeah. Well, thanks again for having me on this webinar. And I kind of agree with Rory's point that OPEC, certainly officially, publicly does not have any kind of price target. They're not going to be so foolish as to disclose that when there are things like antitrust things swirling around them, NOPEC and what have you. So, I think. I see it more as a case of defending a floor on prices, maybe at a $70 a barrel floor than it is targeting at $100 price target. Now, again, if you ask OPEC and if you ask the Saudis, they are going after inventories, right? They're trying to draw down inventories, tighten the market like that. And through production discipline, to the extent that they control it, if inventories fall, then the price will kind of take care of itself. And that's kind of the philosophy that they're going with. And I agree with Rory's point on this. Our colleagues at the FT our friendly competitors at the FT. The story I think really says is what we're in a position right now where we know that these cuts are in place through December. OPEC has given themselves the optionality of keeping the market guessing, in terms of what they want to do. These cuts, the tapering from December, now we're 2 months out, right? That's a lifetime in the oil markets. Anything can happen. And even if you think that, well, actually December production targets have to be set by the beginning of November because of, setting OSPs and allocations to term customers. Well, that's still a month out. So a lot can happen. And, just in my conversations with OPEC officials and Saudi officials, December is so far off. Right now, we're focused on kind of cleaning up our own house, and that's compliance. And the compliance really is the story here, I think. And we know that we have members like Iraq, Kazakhstan, and Russia that have struggled to comply with their quotas. I think if you had OPEC sitting here, they were hoping that there would be a summer of demand here that would have tightened the market. We'd be sitting here at $80 to $90 a barrel, and in a much greater position, much greater leverage on OPEC's part to be able to do something in December, whether that's releasing more barrels, releasing fewer barrels, what have you. But a tighter market is where OPEC really has that leverage. Instead, we're sitting here with prices in the 70s, and now the finger pointing within OPEC is at these quota busters and getting them to tighten up their act. And so, this story in the FT was an attempt by Saudi officials, people familiar with Saudi thinking, that's what it was sourced to kind of fire a warning shot to Iraq and Kazakhstan and Russia that this is a taste of what can happen if you let this market get unravel by your undisciplined approach to these quotas and keeping the market oversupplied. Price is going to fall. This is what's going to happen. And if we get to this December decision, at the beginning of November, and the conditions are still like that, and there's the evidence still points to the fact that you're not heeding your quotas, well, then, perhaps all bets are off. And the nuclear option for Saudi Arabia is always that market share battle that I think everybody in the producer group would like to avoid, but it is there for them. And I think that's clearly the message that I think from my conversations with OPEC officials that they want to get across.
Yeah, great point. And coming back to the forecasts, in the past couple of months, OPEC has actually revised down its demand growth estimate for this year, but its forecast remains higher by more than 1 million barrels a day compared to IEA and EIA. What do you see as the main reasons behind this revision, firstly, but also the massive divergence that persists across the three agencies?
Well, one of the interesting things about this is the implications, obviously, for OPEC plus policy. And one of the questions I did ask Prince Abdulaziz, the Saudi energy minister, at the last OPEC meeting when they had a press briefing is, if the OPEC, short-term market outlook is for this 2 million plus barrels per day of demand growth in 2024, why are you maintaining such tight quotas? OPEC plus, they like to talk about themselves as being proactive, getting ahead of the market. It seems you guys are being a little more reactive in this case. The comment from Prince Abdulaziz was actually, the jury is still out on demand. And so, maybe even not even taking into account the OPEC forecast. If you're a policymaker for an oil producer, I think, again, Prince Abdulaziz's message was, I'll believe it when I see it, and seeing is believing. To be fair, I think demand is something that, I think a lot of forecasters, I'm not a forecaster myself, but maybe Rory can speak to that, but demand is always hard to forecast, I think. It's a bit of a hindsight measurement. I think supply, you can make a reasonable guess, if you assume operating conditions are stable. Obviously, you have to take into account disruptions, hurricanes, maintenance, whatnot. But you can kind of make a reasonable forward assumption that production is going to do this based on the number of rigs, et cetera, exports, what have you. Demand, though, a lot of times it's a very localized story, a lot of moving parts to it, so many inputs into it. And really, it only becomes apparent in hindsight. And so, a lot of right now, we're looking at China. China is the big, unknown factor in the demand market. And this pandemic tailwind that they've had. I know, Tom, you want to get into China a little bit more, but this pandemic tailwind that they've had, is it plateauing out? And some forecasters think so. So other forecasters like OPEC think it's got a little more legs to run. If you're OPEC and you're looking at the prices, and maybe some of that is sentiment dominated, like Rory said, and some of their messaging is targeted at getting those those speculators on their side, right? And so far it hasn't quite worked to the extent that they wanted to. But if you're a policymaker trying to make OPEC policy, you have to kind of wait for these demand signs to turn the corner. And so far, just a lot of signals that are getting out of China. It seems like every week there's a new economic indicator, some data point coming out of China. A lot of mixed messages, and I think that's really why that's clouding the forecast for 2025.
Yeah. Yeah, and Rory, I mean, what do you think? I mean, it's very unusual, if not unprecedented, to see this kind of a divergence in the agencies at this time of the year. I mean, there's only what 3 months left of the year, and such a big divergence in the demand estimate. What do you see behind, well, the recent revision, but also this divergence?
Yeah, you're absolutely right. I mean, this is the first day of the fourth quarter of 2024. The fact that we still have 1 million barrels a day between them is pretty crazy. And I think it's important to note, what these forecasts are for. I don't truly believe that OPEC ministers actually are banking on the Secretariat's demand forecast. I see that forecast really as having been an internally directed message to say, look, there is still a path that we can ease the entirety of this 2.2 million barrels a day of production cuts without oversupplying the market, because OPEC's forecast is the only one that sees that full 2.2 million, 2.5, including the UAE, of kind of returned or increased production without it pushing the market into oversupply. So that said, I think that, the last 2 months, OPEC has finally started cutting that back from this year, from 2.25 million barrels a day to just about 2. Next year, from over 1.8 to close to 1.7. So I want to say a couple things about that. First, I think there was an open question is like, would the Secretariat's demand forecast ever come back down to earth? And the answer is it's starting to. Whether I don't think they're going to converge probably until end of first quarter next year, very frankly. I think that's when you're finally going to see some reconciliation, if that at all. On previous webinars like this, we've talked about how the main drivers of the differences between the IEA, EIA, and OPEC for this year are not many of the regular suspects, although China has become a bigger factor, and we will talk about that more in a moment. But it's actually always been that OPEC has stronger demand forecasts, like structurally, for the Middle East, for Latin America, a lot of these countries and regions that we don't typically talk about as much when we're always talking about US weekly demand or China or India or whatever else. So I think that's the big driver. The other thing I think is really interesting is that when we're talking right now about OPEC being very offside the IEA and EIA forecast this year, OPEC at 2 million barrels a day, EIA and IEA closer to 0.9 million barrels a day, so less than half that. So I think, it's very easy to create this narrative of kind of, OPEC versus Western oil agencies in terms of demand forecast. But what's interesting is that we roll into next year, into 2025, that relationship actually flips a little bit. And the IEA is actually the one that's all by itself down still at 0.9-ish million barrels a day, whereas OPEC and the EIA are more like, 1.5 to, 1.7. And I think that's also really interesting, is because it starts to reveal structural, and I think primarily on the IEA's case, assumptions about continued contraction of OECD demand that the EIA doesn't share. And I think it's easy this year to kind of fall into this West versus OPEC forecast trap. But I think that next year, I think that reverses entirely. And then the IEA is the one standing all alone. So I think that's going to be really interesting to see how it resolves, because this year, as an example, IEA expected initially upwards of like a 0.4 million barrels a day contraction in OECD demand. And as of the latest forecast, that has essentially gone back down to flat. So they've completely backtracked on a contraction of OECD demand, largely because the US has actually been one of the standout areas of growth in demand, largely on the natural gas liquids, but still petroleum overall. So I think that's been a really, really interesting dynamic to see play out.
Yeah, if I could just piggyback on that, I think that the market seems quite focused on this 2025 oversupply story, more so than any notion of Q3, Q4 tightness. And there are some forecasters out there that do say the market is tight. I think UBS is out there, JP Morgan. I think they said a 1 million barrel per day deficit in 3Q. But the market seems more focused on this 2025 oversupply. Now, of course, low oil prices, they can stimulate demand. We are in a environment where interest rates are being cut in some markets. I think one of the things we saw with the pandemic was a really uneven recovery globally. You got some countries, you had lockdown, different lockdown rules. Some countries did better on vaccines, and some countries were just better positioned economically to weather the storm, at least rebound quickly once that pandemic recovery started. So I think the question is not so much on the pandemic, but will we see that kind of phenomenon happen in 2025, where the demand picture is different in different regions? You talked about, Rory, that the demand picture in the US has been quite healthy. China, again, a big black box in terms of what the demand is. They had the stimulus package that they've just implemented to try and juice the economy. I mean, you can kind of read that two ways. Obviously, stimulus is a potential stimulus as it is for the economy, but the fact that they even have to implement a stimulus, is that just a sign of more weakness in the Chinese market than maybe anybody had anticipated? And sometimes you get that with OPEC forecasts, right? If OPEC is forecasting a decline in it's one of those, like, if OPEC is saying that demand, they're having to revise down their forecast on demand. What is is that should we overreact to that that messaging? What is that kind of reading the tea leaves? What are they trying to say with that? And it is, as Rory says, a narrative-driven market these days. So so I think that this 2025 uncertainty on demand, to me, it's just a lot of uncertainties on region by region specific dynamics and how that impacts supply. And we know that supply is growing in the U.S., supply is growing in Brazil, Guyana, a lot of this non-OPEC plus
Canada.
And Canada, yes, Canada as well. I can't leave Canada out of it. That Trans Mountain Pipeline, a big deal as well to the market. So we know non-OPEC plus supply is going gangbusters, and where is that demand? How is that demand going to meet it? And some forecasters say the demand's going to fall well short. And if you kind of dial down into it more granularly, where is that demand going to fall short? And if it's a place like China that's going to fall short, even with the stimulus, I think that's a lot of trouble in terms of if you're an oil producer.
Yeah, I mean, it's an interesting point about whether, forecasts and outlooks reflect some sort of signaling exercise or whether they're more kind of data led. And particularly with the outlooks, the longer term outlooks, we see a lot more signaling, I think, and less kind of data driven approaches. But I mean, looking next year, I mean, Rory, you raised the issue of next year, 2025. And looking at the call on crude for the DOC, projections from the agencies are showing, again, a big discrepancy. What do you think's behind that gap, and where do you think it's going to kind of settle up in 2025?
Yeah, so I mean, just to kind of put in kind of our leader table, if you will. So OPEC unsurprisingly sees the most demand for OPEC barrels. Even if you have a full return, they still see some kind of modest deficit next year, even with a full return of DOC barrels. So I think that is, again, where I was saying this kind of internal messaging exercise, that is the source of hope that, look, we can return these barrels and everything will be fine. But very frankly, I don't think anyone really truly believes it. I think that most forecasts are actually, I think, closer, particularly for next year, to the EIA's forecast, which kind of lands in the middle, that shows that if the DOC, or Department of Cooperation, Declaration of Cooperation, sorry, the department, anyways, sorry, if that remains flat, the EIA actually sees the market still in a reasonable degree of deficit. And I think, so the EIA is actually saying that we do need some return. I mean, this is my own kind of pet project, but my argument has always been that the market really can't absorb, in my mind, 2.2 million barrels a day of return without kind of tanking prices. And this on again, off again messaging from OPEC, I think, is really running, wreaking havoc on this narrative driven market. I think that's really difficult. It's difficult to kind of maintain a sense of like firm kind of authority on kind of where this is going if you keep pushing it back or keep adjusting. So I hear on the flexibility, but I do think that, most forecasts show that it can't take 2.2. So why don't we just cut in half? Let's say 1.1. And then come hell or high water, say, we're going through. And I think that would, on the EIA's forecast, which I think is closest to my own kind of base case assumptions for next year, that shows that the market would be more or less balanced. You would probably see prices linger around where they currently are. And OPEC would at least start the process of easing these production cuts and showing the membership that this isn't permanent. That said, on the really bearish side is the IEA. And that basically shows that even if OPEC remains flat or OPEC plus remains flat, the market still actually dips in and out of surplus next year. And I think that is obviously this really, really bearish forecast, because that almost implies that not only can't they cut production, they kind of, if they want to maintain any kind of price floor, as Herman was alluding to, they might be forced to even cut more. And I think that is this kind of really terrible scenario for OPEC. But I also think that the IEA's forecast, like I was saying, is kind of on its own now, and continuing to expect kind of very pronounced contraction in OECD demand is really the largest driver. I think it's upwards of almost 5 million barrels a day of demand growth assumption between the IEA on contraction and the EIA and OPEC on kind of continued OECD growth, largely driven by the United States. So I think this is really an area that you see. I always say that like global demand sets the speed limit by which OPEC will essentially get to determine where, how much they can return to the market. So demand forecasts are going to drive this. And I think we're going to come to China. I have lots more to say on China, but I'll leave that for a second and hear what kind of Herman says on the global balances.
Yeah, no, I think this comes back sort of back to the compliance issue on OPEC plus, right? I mean, Iraq on its own, I think the calculations from the secondary sources, they were 230,000 barrels per day over their quota in August. And this tapering of OPEC plus cuts that was supposed to start this month, October, I think it was like 190,000 barrels. So Iraq, just on its own, 40,000 barrels per day above what the tapering was meant to be, right? And so that's kind of ruined the party for everyone else. And then you take into account Kazakhstan, which actually was compliant in August because of Tengiz maintenance, but Tengiz is coming off maintenance, so we're expecting September production to be up quite a bit. They'll be back in the quota busting category. Russia has as well slipped at times in its compliance. And so, so on the supply side of things, we've been talking a lot about demand, but on the supply side of things, can OPEC plus keep its house in order? And in the conversations I'm just having, this is what's causing a lot of tensions within the OPEC plus group, right? And if there are free riders within the group, well, that just irritates everybody, and that makes the big question about cohesion within the group. And I'm told that some of these conversations with the Iraqis, with the Kazakhs, have been quite tense, quite harsh. The messaging is quite harsh, and again, I think the nuclear option of that market share battle is what the card that Saudi Arabia holds, and do they tank prices down to $50 a barrel or even lower? That's and then everyone loses, right? So that So on the supply side of things, how's OPEC Plus going to manage this, right? The message I hear is that Iraq has basically 2 months to get its house in order to become compliant, or else we'll have to see what OPEC Plus do. But will the cheaters comply? Then you have other countries like the UAE, right? Will they be willing to maintain production discipline when the price gains aren't there, right? If we're still stuck at $70 a barrel. Why are we cutting so much? Saudi Arabia, the IMF saying economic growth, they're revising that downward because of the OPEC plus cuts, right? So how long can they tolerate these conditions? Tom, at the start, you talked about Saudi Arabia cutting spending. Is that a direct correlation to oil prices? Arguably, probably so, right? The oil markets, we've got a lot of moving parts, but right now, what OPEC Plus can control is compliance, and so far they've not done a good job with it.
Yeah, very good point. So look, we're making great progress here, but watching the clock, we haven't got that much more time. But I'd love to address two more really kind of big questions. One is China and Chinese data, and the second one is really peak demand and looking a bit further into the future. But I mean, staying with China for a second. Rory, I mean, the OPEC's estimates for Chinese demand were higher by more than 500,000 barrels a day year on year compared to the estimates of EIA and IEA. So what do you think's behind that? And if I could just add on an extra dimension, what do you think of the reasons behind the deceleration in Chinese oil demand growth? And do you think it's structural, or how do you see it having an impact on the global market, and particularly from a kind of energy transition perspective? Is that a factor there as well?
Yeah, so I think we could do a full hour just on Chinese demand. So I'm going to try and whip through this. Anyone that follows Chinese oil demand data knows that it's not particularly good. It's essentially kind of inferring from shadows, disappearance of barrels within the economy. We know for sure it's weak. I think there's ample debate as to how weak. my own tracking of what I call apparent Chinese demand actually shows that through August, we're now in year-to-date contraction, very, very modestly by about 70,000 barrels a day, which if that held through the end of the year, would be the second time in about 30 plus years that China had an annual average decline in demand, with the only other year being 2022 during the kind of peak of the draconian COVID zero lockdown. So this is very, very weird for the oil market. And I think, well, it's also interesting that while OPEC right now holds definitely the highest forecast around 650,000 barrels a day versus IA and EIA, which are more like 100 to 200,000 barrels a day now, which may still prove to actually be too strong for the record if this continues. It's interesting that if you rewind even a couple months, at the beginning of the year, the IEA actually held a notably stronger forecast for Chinese demand than did OPEC. So OPEC has actually drifted higher in its forecast as you started. It essentially filled in for losses in a couple other regions that were starting to contract a little faster. So hope was on China. Whereas, the IEA went from, I think at the beginning of the year, they were forecasting somewhere upwards of 800,000 barrels a day of additional demand in China. And now it's more like 200,000 barrels a day. And based on the way it's going, likely heading for flat to contraction. So I think that is the challenge here is it's really, really hard if we're talking about essentially 1 to 2 million barrels a day of demand growth globally. If you're chopping off 700,000 barrels a day of Chinese demand, that's a really, really big shoes to fill. So when people talk about India or talk about the rest of kind of the emerging markets, that essentially combined has to make up for China, and it often can't do it. So I think that's the big challenge right now is who's going to fill in for China immediately in a real way. In terms of the drivers, and I think the question of are these structural or just simply cyclical factors? I think that is, a much more important and much more difficult to assess question, given what I was just saying about the kind of lack of specificity of Chinese demand data. China doesn't have EIA level kind of granular breakdown of demand. When you look at the kind of major drivers, what's interesting when people talk about things like EV penetration, you see a lot of headlines, more than half of Chinese vehicle sales now are electric vehicles. That's massive. This is a crazy degree of penetration, way faster than anyone had really forecast, except the most ambitious forecasts. But what's interesting is that up for most of the year, gasoline has actually been one of the sole sources of growth maintaining in China, whereas it's been diesel, fuel oil, and industrial products that have really felt the brunt of that contraction. So I think when you look at, let's say, the cyclicality of it, you have to link that to the kind of beleaguered and contracting real estate sector. The numbers and the scale of the contraction in Chinese real estate is just unfathomable. So that is definitely going to have an impact on diesel. But at the same time, so that's the cyclical factor. Eventually that's going to normalize. Eventually that's going to at least stop contracting. But you've also seen a lot of stories about things like LNG or CNG or compressed natural gas penetration in commercial trucking, which is something that, when you look at these long-term forecasts, I've put together many myself. Typically, you've seen diesel remains the kind of stalwart kind of structural base of those forecasts going forward, whereas gasoline peaks and rolls over because of EV penetration. But what we're seeing globally, both in China due to natural gas penetration, and indeed even in the United States due to renewable diesel penetration, is that right now middle distillates like diesel are actually feeling the brunt of downside pressure above and beyond what we're seeing in gasoline. Some of that is able to be displaced into jet fuel, which is still doing well across the world, but diesel is definitely a source of pain. And you see that in the diesel futures contracts as well. Term structure is weak. So I think that I would, just for really, really simple, I think probably half of it is cyclical, and the other half I think is indeed structural. And Beijing has had a long mandate to try and wean off the need for imported foreign oil. Above and beyond any economic rationale, there's that national security and kind of self-sufficiency rationale that will always seem foreign to kind of Western market-based governments, but I think is largely driving the boat on this.
Yeah, I'm speaking to you here from Fujairah at the Gulf Intelligence Energy Markets Forum, and the topic of China, as you can imagine, did come up today. And it was interesting, some comments from Torbjorn Tornquist from the Gunvor chairman. He was asked about Chinese demand and the stimulus package that China, and would that be bullish for oil prices? And he's of the view that the growth engine of China, there's still growth there, but as Rory talked about, it's the industrial growth that isn't quite there anymore, and that it's a much less energy intensive economic growth that we're seeing out of China. It's like the LPGs and with the EV substitution, the CNG, LNG, right? It's much less. It's not that diesel. It's not that the middle distillates that are driving the growth there anymore. Now, the stimulus package is trying to juice the property market. So we'll have to see what that does for construction, whether that can effect a structural change or whether that's just a temporary bullish jump in oil markets and then it kind of settles back into it. So, this Chinese question is really, going to be a big one.
Yeah, great. Well, just looking at the clock here, we've got 5 minutes left. So I think we better address the let's say the last elephant in the room, which is the peak oil demand and I mean various assumptions around that. But I noticed the IEA recently once again kind of reiterated its expectation that oil demand will plateau this decade based on their diminishing numbers on demand growth going forward. But I mean, what do you think? What is the data telling us about demand growth in a slightly longer term? I mean, beyond next year, looking forward at the midterm. Rory, do you want to give us your thoughts on that?
Yeah, I mean, long-term oil demand forecasts are about the most fraught possible thing you can spend a lot of time and emotional energy defending. But I will say that what's interesting is for a long time, I kind of, didn't spend that much time on it because, they change constantly. It's kind of finger to the wind on a policy tone or tenor of the day. But what's interesting is I think that was easier to do when that was in the IEA's long-term forecast. It's now, as you were mentioning, entered the medium-term forecast. So the next 5 years now, by the end of the decade, the IEA expects oil demand to peak globally 2028. I think it's 2029 is the latest number, but it's officially now in that window. And what you see is that's actually starting, people had always separated the long-term and even the medium-term outlook with the short-term, the oil market report and the kind of data that everyone uses to really judge the kind of fundamental tone and structure of the market. That I think those assumptions around transition, those assumptions around peak demand creeping forward have started creeping into the medium term and even the oil market report. I mentioned earlier how the IEA expects OECD demand to fall next year, and they expected it to fall this year, and they backtracked in a dramatic fashion. I think that's what you're going to see increasingly. So given that their models now start to drive into the kind of current discussion period, you're going to see, I think, going forward, a repeated, a consistent repeat of this dynamic where the EIA even, I think we can even exclude OPEC for a second, because if we're saying, sure, OPEC's biased, whatever, let's just compare EIA and IEA. IEA sees this kind of structural assumption of demand contracting in OECD going forward, essentially now until forever. EIA doesn't believe that. And I think that is actually going to be a very, next year alone, it's 500, 600,000 barrels a day of difference. That's a huge amount, even over a couple of years, and will be the major difference between a market that can flexibly absorb OPEC's return of barrels and one that simply can't and keeps OPEC on its back feet in perpetuity. So I think ultimately it's going to be policy dependent, and ultimately it's going to depend on whether or not China flatlines or contracts in perpetuity. Going back to that, no one can really fill China's shoes by themselves. So, but I think it's going to be really interesting because will the IEA be right next year, or will they once again need to backtrack on the assumption of OECD contraction?
Yeah, no, very interesting. Herman, what do you think?
Yeah, I mean, I guess I'll just comment really quickly on the OPEC World Oil Outlook that got released last week. And one of the interesting things I saw in there was that, all right, no peak demand through 2050, whether you believe that or not. But if you do believe it, the call on OPEC plus liquids has to rise 12.7 million barrels per day by 2050. And the big question in my mind is, where is that going to come from, right? I mean, we've got Aramco canceling their expansion to 13 million barrels per day, citing market conditions, right? ADNOC, they're supposed to get to 5 million barrels per day by 2027. They're already at 4.65, right? So how much more can they go? Iraq has potential, but there's political problems. So, where is this OPEC plus crude, this extra 12.7 million barrels per day to balance the market, going to come from by 2050? And OPEC, likes to say that, all this rhetoric from the IEA is destroying the investment case for oil and gas. This is an existential problem, and it's going to be hugely damaging to the world economy. But if you look at this OPEC Plus report, OPEC Plus itself is going to have to start investing massive quantities of money in upstream production to meet their own forecast. And so this is all coming up, of course, with NDC commitments, with net zero commitments. How's that all going to fit together? I just, it's a big question in my mind how this OPEC plus forecast is going to be met on the supply side by OPEC plus.
Yeah. Well, great. Thanks, Rory and Herman, for a fascinating discussion today. And thanks to all the people watching the live stream. I'm sorry we're out of time, but stay tuned to the IEF on social media for news on the next edition of the webinar. This is Tom Ashby signing off from the headquarters of the International Energy Forum. See you again soon.